Volatility is present. It has not disappeared, and it has not arrived. What exists now is not direction and not intent, but movement that continues to express itself without resolution. Price is active, yet structure remains unchanged. Nothing has been accepted. Nothing has been rejected. Time has passed, but time has not transformed the condition. What we observe is not an increase or decrease in volatility, but the persistence of behavior. Compression has not resolved. Expansion has not confirmed anything. The market is still behaving, not deciding. This is not a calm state, and not a volatile state. It is a state where movement exists, without structural consequence. That condition remains in place. Volatility does not act once. It repeats. It breathes. It expands, contracts, and sometimes absorbs its own movement. Price may travel distance without changing anything that matters structurally. This is where confusion often appears, because movement is mistaken for change. But volatility does not care about direction. It expresses energy, not outcome. Compression is not preparation. Expansion is not confirmation. Both can occur inside a structure that remains fully intact. Time allows volatility to test itself, not to resolve, but to express. When expansion fails to carry forward, it does not mean reversal. When compression persists, it does not mean anticipation. It only means that volatility is interacting with time, without permission to alter structure. This repetition is not inefficiency. It is not delay. It is behavior being observed, without interpretation. Nothing needs to happen. Nothing is missing. Bollinger Bands do not announce events. They describe how volatility occupies space, and how that space is permitted to widen, and how that space is permitted to narrow, without implying consequence. When the bands compress, nothing is being prepared. Containment is simply being shown. Price can still move, and the movement can still feel large, yet the bands can remain compressed, because volatility is not obliged to expand. When the bands expand, nothing is being confirmed. Dispersion is simply being shown. The widening itself is not a message. The widening is only a record of behavior, a record that volatility is spending itself outward, instead of holding itself inward. Sometimes the upper band lifts, and price reaches toward it, not as a breakout, but as contact with a boundary that exists. Sometimes the lower band drops, and price leans into it, not as failure, but as interaction with a limit that is still present. The bands can widen, then stop widening, then narrow again, without structure changing at all. That is not reversal. That is not continuation. That is volatility breathing, inside time, without resolution. Moving averages do not guide price. They do not lead. They do not pull. They record how time has been spent. When price remains close to an average, it does not imply control. It implies proximity. Time is being spent near a reference, without urgency to separate. When price separates from an average, it does not imply commitment. It implies distance. Time is being spent away from a reference, and the distance itself becomes visible, not as direction, but as condition. Averages can flatten, not as indecision, but as a sign that time is being distributed evenly. Averages can slope, not as momentum, but as a sign that time is being distributed unevenly. And the slope can persist while nothing resolves. Because a moving average is not a trigger. It is not a rule. It is only a way to see time accumulating, and to notice whether price is spending that time near or spending that time away. RSI does not measure strength. It measures pace, how participation accelerates, how participation slows, and how long that pacing can persist without changing anything structurally. A rising RSI does not mean dominance. A falling RSI does not mean weakness. It shows tempo, the speed of participation, not the meaning of participation. I can lift quickly, then stop lifting, then drift sideways, while price continues to move. I can drop quickly, then stop dropping, then stabilize, while price remains unsettled. That is not confirmation. That is not warning. That is the pacing of participation. Finding a ceiling, finding a floor, or finding neither, and continuing anyway. Sometimes RSI stays elevated, not because a trend is confirmed, but because the market keeps spending time with faster participation. Sometimes RSI stays depressed, not because failure is proven, but because the market keeps spending time with slower participation. Tempo can persist, without outcome. When these descriptors appear together, they are not agreeing. They are describing the same behavior in different languages. Volatility occupies space. Time is being spent near or away. Participation changes pace. None of these are conclusions. And the overlap does not create certainty. A band expansion can appear while averages remain unchanged. An average slope can persist while bands stop widening. I can drift while both bands and averages hold steady. These are not contradictions. They are the same market showing behavior through multiple frames without granting permission for interpretation. What matters here is that time continues. Several candles print, and the structure may remain untouched. Several hours pass, and the condition may still be unresolved. Nothing is missing. Nothing needs to happen. Volatility can be loud and still be structurally silent. And until time transforms structure, this remains behavior, observed, contained, and unresolved.